Are you leaving free money on the table without even realizing it? What if I told you that one simple decision today could mean the difference between paying thousands in taxes later or enjoying that money tax-free? It sounds complicated, but retirement accounts are actually your biggest tax advantage. Understand them once, and you can literally grow your wealth on autopilot. Welcome back to our channel, your guide on the path to financial independence. In this 12th episode of our 30-part series, we're diving deep into building your wealth for the long term. Today, we're breaking down the confusing world of retirement accounts, 401ks, IRAs, Roths, and more, all in simple, easy-to-understand language. By the end of this video, you'll know exactly which account is right for you and how to use it to secure your financial future. Let's start with the basics. What are these accounts anyway? Think of them as special savings accounts with powerful tax benefits designed to help you save for the future. The government wants you to save for retirement, so they give you these perks as a reward. First up is the 401k. This is probably the one you've heard of most. It's a retirement plan offered by your employer. The best part? Many companies offer a match. This means if you contribute a certain percentage of your salary, your employer will contribute money too, often matching your contribution up to a certain limit. It's literally free money. A recent survey showed that nearly 1 in 4 employees do UNT contribute enough to get their full employer match. That's like turning down a raise. Are you one of them? We'll get back to why that's a huge mistake. Next, we have the IRA, which stands for Individual Retirement Arrangement. You open this one on your own, not through your employer. There are 2 main types. First, the traditional IRA. Here's the deal. You contribute money now, and you might get a tax deduction for it this year. This lowers your taxable income, which is great if you want to save on taxes right now. The money grows over time, and you only pay taxes when you take it out in retirement. Then there's its popular sibling, the Roth IRA. This one works the opposite way. You contribute money that you've already paid taxes on, so there's no tax deduction today. But here's the magic. All your money, including all the investment gains, grows completely tax-free. When you withdraw it in retirement, you owe 0 taxes. Not a single penny. It's a huge deal, and we'll show you just how huge with an example later. What if you're self-employed or a freelancer? Don't worry, there are options for you too. There's the SEPI IRA and the Solo 401k. These are designed for business owners and freelancers, allowing you to save a much larger portion of your income for retirement compared to a traditional IRA. Finally, there's a secret weapon many people overlook, the HSA or Health Savings Account. While it's meant for healthcare costs, it has a triple tax benefit. Your contributions are tax deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. After age 65, you can withdraw money for any reason. Just like a traditional IRA, it's one of the most powerful retirement tools available. Okay, so we have all these accounts. How are they different, and which one should you choose? Let's break it down. The 401k is powerful because of its high contribution limits. Now, let's compare the traditional IRA versus the Roth IRA. The big question is, do you want a tax break now or a tax break later? With a traditional IRA, you get the deduction now. This is beneficial if you're in a high tax bracket today and expect to be in a lower one when you retire. For example, if you're a high-earning professional at your peak, a traditional IRA can lower your current tax bill significantly. But what if you're just starting your career? Salary income is likely lower now than it will be in 20 or 30 years. This is where the Roth IRA shines. You pay taxes on your contributions now, while you're in a lower tax bracket. Then, you let that money compound for decades. When you retire, and you're likely in a higher tax bracket, all those withdrawals are tax-free. Another amazing feature of the Roth IRA is that you can withdraw your original contributions, not the earnings, or to put in at any time, for any reason, without taxes or penalties. This gives it incredible flexibility. So, how do you choose what's right for you? It's like building a financial house. You need a solid foundation first. Step 1, and I can't say this enough. If your employer offers a 401k match, contribute enough to get the full match. Period. It's the best investment return you will ever get, guaranteed. Don't leave this free money on the table. Step 2. After getting the match, consider opening a Roth IRA. Why? Most financial experts agree that tax rates are more likely to go up in the future than down. By paying your taxes now with a Roth IRA, you protect your future self from potentially higher tax rates. If you're young and your income is still growing, the Roth IRA is almost always the better choice. You lock in today's lower tax rate forever. Step 3. If you've either maxed out your Roth IRA for the year, the 2024 limit is $7,000, or $8,000 if you're 50 or over, then go back to your 401k. Contribute as much as you can, up to the annual limit. This is where you really supercharge your long-term compounding growth. The high contribution limits of a 401k allow you to put away a serious amount of money. What if you need a tax break right now? Maybe you've got a big bonus or have a high income and want to lower your current tax bill. In that case, after getting your 401k match, you might choose a traditional IRA over a Roth IRA to get that immediate tax deduction. Let's see how this plays out in the real world. Imagine two friends, Anna and Ben. Both are 30 years old and earn $50,000 a year. They each decide to contribute $5,000 a year to an IRA for the next 30 years, earning an average return of 8% per year. Anna chooses a Roth IRA. She pays taxes on her $5,000 contribution each year. Her money grows. Ben chooses a traditional IRA. He gets a tax deduction on his $5,000 contribution each year, saving him some money on his taxes today. His money also grows. Fast forward 30 years. At age 60, both Anna starts withdrawing money from her Roth IRA to live on. How much tax does she pay? Zero. Absolutely nothing. That $611,000 is all hers. Free and clear. Nows. What about Ben? He starts withdrawing money from his traditional IRA. Every single dollar he takes out is taxed as ordinary income. If he's in a 22% federal tax bracket in retirement, and let's say a 5% state tax bracket, he loses 27% of every withdrawal to taxes. If he withdraws $40,000 a year to live on, he'll owe over $10,000 in taxes that year alone. Over the course of his retirement, that adds up to hundreds of thousands of dollars lost to taxes money he could have used for travel, hobbies, or leaving a legacy. Anna has more spending power, more financial freedom, and more peace of mind. All because she chose to pay taxes up front when her income was lower. This is the incredible power of choosing the right account. Choose the right retirement account today gives you freedom tomorrow. It's not just about saving money, it's about saving money in the smartest way possible to keep more of it for yourself. Don't let fear of the unknown stop you. Take that first step. Check your employer's 401k match. Open an IRA. Even starting with just a small amount makes a huge difference over time, thanks to the magic of compounding. Your future self will thank you. Thanks for watching. This helped clear things up. Make sure to hit that like button and subscribe for more practical financial tips. See you in the next video.